When interest rates were spiking last year, and tens got up around 5%, you could see that there was a lot of pressure on the bond market because of issuance, right? We had these huge auctions and issuance was weighing on the market and it was causing interest rates to go higher. And I said at the time, I was like, look, people thought that we would get failed auctions and issuance can go higher. But I said, demand can rise to meet supply, right? And, for a lot of people, 5% on tens looks pretty attractive, especially after a period of time where we had, really low interest rates. So I was of the opinion that demand would rise to meet supply, and we wouldn't have this problem of interest rates going to 7 or 8 or 9%.
Hello and welcome to Wealthion. I'm your host, Andrew Brill. We have some hot off-the-press economic data to pour over, and Roaring Kitty is back. We'll analyze all of that right now. We welcome in Jared Dillian to Wealthion. Jared is the author of the daily Dirt Nap financial newsletter. He's also an entrepreneur, trader, musician, writer, and an educator. Jared, welcome to Wealthion.
Hey, thanks. Thanks for having me.
It's funny. I read somewhere a great quote from you that said something like, you like to teach people how not to be stupid with their money. Everybody says, oh, we want to teach you how to be, the smart money this, the smart money that, but you're teaching people how not to be stupid with their money. And I loved that.
Yeah, it's, I got to tell you, people, there's a lot you can do in terms of preventing bad outcomes when it comes to people managing their own finances. So,
well, congratulations on the new house. I know you just moved in. And if for everybody watching, Jared's office, probably one of the cooler offices around. The book covers on the wall, and your whole setup is awesome. So
yeah, I am really happy with this. So I moved into this office on Monday, and it's a big space. Like you said, I got the book covers on the wall. I got my diplomas. I got the desk in the middle. I got a porch out here where I can smoke cigars if I want to. Talk on the phone. Like actually over there, I have a podcast studio, which ordinarily I would be doing this, but I don't have all my stuff yet. It's still in my old office. So, but yeah, this is actually kind of a nice background with all the trees in the back, and it's really nice.
Yeah, it looks great. Well, congratulations and all the best of luck to you in your new digs. So let's get right into it. CPI numbers out as we record this on Wednesday, fresh off the, hot off the press and slightly down. I don't know. What do you make of 3.5 versus 3.4?
Well, I guess I think you can kind of tell how people were positioned going into this based on the reaction after the number. In bonds, I think people were massively short, expecting a hotter number. Twos, tens, basically across the curve, like everything rallied pretty hard on the release. It's come off a little bit since then. But I kind of had a sense that was going to happen. Just the inflationary sentiment had picked up quite a bit going into the CPI release. Commodities have begun rallying again. Copper has gone parabolic in the last couple of days. So I think people were expecting a really hot number. And even an inline number caused 2-year notes to rally like 10 or 12 basis points. So,
right. And the market obviously reacting. What is your overall take on the economy right now? It seems to be, unemployment is kind of ticking up. And now it looks like the Fed, although it's only been 2 numbers in a row that have come down, now the Fed's labors seem to be working and inflation is starting to come down. What's your overall take?
Well, I think we're starting to see some early anecdotal signs of slowing. First of all, we got a claims number last week that was kind of crappy. That's one number that doesn't really mean anything. We need to get like 3 or 4 more numbers before, you can kind of look at the 4-week moving average of claims. So we need to see some more data there. Home Depot sales have been down 6 quarters in a row. I think that's an interesting data point. I've been getting into arguments with my subscribers about Costco. I said Costco probably has the most gearing to the economy than any other stock. And if there's a small downtick in sales, it's trading at 45 times forward earnings. You could see a big correction in Costco. So it's those, economically sensitive retail stocks that I think you have to watch for clues in the economy. Along with CPI today, we got retail sales, and that was actually terrible. I'm looking at this right now. Retail sales, ex auto and gas, was down month over month. It was down 0.1%. So once again, that's one number, but I think we're a lot closer to the end of this bull market than the beginning.
So inflation is actually going to come down a little bit, and you think we're going to the money that's on the sidelines is going to kind of stay on the sidelines for a little while longer until the market comes down more. It hit new intraday highs today with some of the Nasdaq, the S&P, they hit intraday highs, I believe. So with this CPI news, so there's I guess there's an opportunity for some of that cash that's sitting on the sideline to get in, not soon, but the not too distant future.
Yeah, yeah, I agree. I agree.
So in terms of the economic data and the unemployment, and you brought up the Costco end of it, isn't that more of a bargain shopper thing where people go looking for deals where they're going to spend money in places like that? Or is it,
So,
go
I
ahead.
mean, yes and no. I don't know if I have the words to explain this. Costco is kind of an interesting animal because, yes, it is a bargain place, but it's not a dollar store, right? It's not like a down market place to shop. It's a wholesale outlet, and when people go there, they typically spend large sums of money, multiple hundreds, even thousands of dollars when they go to Costco. Um, so I just moved into this new house and we went to Costco. And, the funny thing about Costco is I didn't know this. I literally just got a membership. They only take Visa. They don't take
Right.
MasterCard. They don't take American Express. They don't take Discover. And I don't have a Visa card. So my only option was to pay cash. And so I brought a lot of cash and I paid $1,300 in cash for a bunch of stuff at Costco. And I'm sitting here wondering, I'm like, how many other people do this? Like,
Yeah, I agree. You go into Costco and think, oh, you know what? I just need a few things, and a ginormous shopping cart later, you've spent $600 or $700 like I did on Sunday, or
yep.
$1,300 like you did. So I guess you don't get out of there unscathed.
Yeah.
And another measure of the economy, and I'm wondering if the Home Depot drop in sales has to do with the pandemic, where so many people were home and so many people were doing work on their homes that there's no more work to be done in the immediate future. So is it possible there's a point where, while they did so well over the pandemic months, that right now they're feeling the effects of that, where people aren't doing as much work?
For sure. I think because of the pandemic, they pulled forward a lot of revenue, and so that's actually a pretty good point. Declining sales at Home Depot might not really be an indicator of the health of the economy. It just might be an indicator that they pulled forward so much sales, and they have a high water mark, and now they're below the high water mark. So
So with retail sales, obviously retail sales are going down. People are spending less money is the assumption there, and there's the unemployment is ticking up. So something seems to be working. Not that you want to see people out of work, but it seems that with fewer people working, not that many fewer people working, but more unemployment claims, you would think that those retail sales would go down even further and affect the economy even further, which is kind of what the Fed is looking for.
yeah, it's what the Fed is looking for. I mean, getting into the Fed, people, I love to talk about the Fed. I think the Fed's super interesting. I talk about the Fed all the time. Really, what people are arguing about here is one potential cut, whether we get one cut before the election or nothing. And that's not a super interesting thing to argue about. Um, what was more interesting was in 2021 when the Fed started to raise rates, and they raised about 400 or 500 basis points in a year, and we were in a rate hike cycle. We're not really in a cycle right now. I mean, one of the interesting things about this is that Fed funds have been unch for about 8 or 9 months, which is the longest that the Fed has not cut rates after a rate hike cycle. So the previous longest period of time was 7 months, which happened in the mid 2000s, and we are now beyond that. So we have had 5.5% Fed funds for the last 9 months, and I kind of go back and forth on this. At the moment, I don't think we get a cut before the election, so I think we're going to have at least a year plus of 5.5% Fed funds, and we'll see what happens next year.
And do you think people are getting used to the 5.5%? It's been around. Look, the more you do something, the more you get used to it. And we're in this economy now that's, it's 5.5%. It's been there. The Fed is saying, look, you know what? That's where it's going to be. We're going to be higher for longer. And people are just getting used to it. Will there come a point, in your opinion, where people will be like, okay, you know what? This is what the rate is. I'm going to go buy a house. I'm going to go buy an apartment, or I'm going to go buy a new car and finance that.
Yeah, and I think, I mean, look, the first house that I bought, I was 24 years old in 1998. I had a 7.25% mortgage, right? And mortgages got down to 2.5%. And I think that, at the time I was thinking to myself, like, how the hell did I afford a house with a 7.25% mortgage? But then, I have like these old subscribers on my list, that are like in their 60s and 70s. And they're like, well, in the 70s, I got a house at 14% or something like that. Like, I guess what people don't understand is the economy doesn't grind to a halt when you get higher interest rates. Like, even if we had 8, 9, 10% mortgages, sure, it would affect the real estate market, but people have to move, people have to buy homes, they will buy homes, it'll affect valuations. But it's not as if we go into a depression because we have abnormally high interest rates. And like you said, people have become used to higher interest rates. They're getting comfortable with it. So,
With those high interest rates, Jared, the increase in wages is it's still increasing, but it's increasing at a lower rate. So there's a point where the unaffordability of some of these things, whether it be goods that you need to live on or a home or stuff like that, becomes less attainable. Is that also something the Fed looks at?
oh, I mean, for sure they look at it. You know, yeah, I mean, I think I don't know. Like, I think they're very sensitive to that. I think they're very sensitive about raising interest rates more. But I got to tell you, it back when interest rates were low or zero, the conventional wisdom was that the economy would not be able to tolerate even 1 or 2% Fed funds. Like, the economy would not be able to tolerate it. We would slip back into a recession, and here we are at 5.5% Fed funds. And, and there's a lot of theories on this. Like, people have said that maybe higher interest rates are actually stimulative, right? Like, people have said maybe the opposite is true. Maybe higher interest rates are stimulative. Maybe people have so much cash in money market funds that they're earning 5.5% on, and it's actually providing a stimulative effect to the economy. So I don't know the answer to that, but raising interest rates 500 basis points hasn't really slowed the economy down a lot. So
Is something like bonds someplace where people should be? At 5% these days, not a terrible return. If you have a chunk of money that you're going to sink into that, it's fairly safe. And is that a place where people should put their money these days?
well, I think people should have an allocation to bonds all the time, no matter what. I have the awesome portfolio, which you probably heard about,
Sure.
which is 20% stocks, bonds, gold, cash, and real estate. And the number one question I get on the awesome portfolio is, why do you want an allocation to bonds? And my answer is, you never know. Like, we could go into a recession tomorrow and tens could go from 4.5 to 2.5. And if you didn't have an allocation to bonds, you would miss out on it. Like, we just cannot predict the future. So you have to have an allocation.
Is that a leverage thing? If you have the 10-year bonds, and let's say they're at 5%, bonds go down to 2.5%, are you able to sell those to somebody else?
Oh, for sure. Yeah. Yeah,
So
for sure.
so that's actually, it's probably a good asset to have.
Yep.
Conversely, I know that you in your newsletter you say gold sucks, but gold now hovering around 2370, could go higher. What's your feeling on gold?
Yeah. So, what's kind of interesting is that when an asset class is at all time highs, technical analysis kind of goes out the window. It's very hard to, in gold in particular, trades very technically. It's kind of hard to analyze trend extension. People have put price targets on gold. They say it's going to go to 2,500, 3,000. It's kind of hard to tell. We traded up to 2430 at the point at which Iran attacked Israel with that drone attack, and we traded off quite a bit. And now I think we're kind of consolidating, getting ready for a move higher. But in the last couple of weeks, anytime we've gotten up around 2370, 2375, gold has gotten smacked down, and that happened this morning. That happened this morning. It traded up to 2378 after the CPI release, and now it's trading at 2361.
So that it's fighting that number, that 2370, 2375 number. It's actually fighting that. Once it breaks through that, you think it could go back to that 2400 number?
Yeah, for sure. Yeah.
So let's talk a little bit about Roaring Kitty. And I know that you wrote about some of this morning, and he's been absent a little bit, probably about 3 years since the last time GameStop went crazy. But one strange post, and everybody jumps back on board. I don't get it, and I don't think I'm smart enough to understand what a guy leaning forward in a chair means. But these meme stops, Jared, what do we make of these?
Well, first of all, I think the most interesting part of this doesn't have anything to do with the markets. Um, what's this guy's name? Gill.
Yeah,
What's his
something
name?
Gill.
Sean Gills, something I can't remember. Um,
Keith
he's
Keith Gill.
Keith Gill. He's pretty clever. Like, obviously he's pumping the stock, right? But the SEC, I mean, like, the SEC can't go after him in court and say that a guy leaning forward in a chair is a pump. You know what I mean? He's not saying anything. He's posting memes, he's posting gifs. Like, I mean, obviously it's a pump, but like, it would never hold up in court. So I mean, I don't know how much GameStop he bought before he started doing this. Um, what was interesting the last time around. I don't think he sold any. I think he sold none. So I kind of wonder if he's selling into this. Like, I have no idea. So
Wow. Because I know, I watched the movie and I lived through it just like you did. And I watched a lot of people make some money. And then there were some that obviously who were shorting it that lost their shirts and needed to be helped out. And those were the professionals. So I guess it works out. But can the SEC do anything about this? Obviously he had to testify in front of Congress before, but posting something like that. Look, if I posted something, nobody's going to give a darn. But this guy goes and posts something. Like, if you posted something strange, people are like, oh, I wonder what Jared means by that. Maybe I should go out and buy a rocking chair stock.
yeah, I don't know.
Yeah,
I
so
don't
it's
know.
it's one of those things. But there's other stocks that you write about, and I know Google has been on your radar for a little while, and now they're going through layoffs. And there's another stock, it's funny because Google has become like the brand Band-Aid. It's like, oh, somebody wants to know about it. Oh, go Google it. And it's become that brand name. How
Yeah,
long
I
would it take
mean,
to knock that off its pedestal?
it's funny. There's been a lot of high profile people, including Stan Druckenmiller, who've said they don't even use Google anymore. They use Perplexity, which is a new AI search engine. And I've used Perplexity. Um, so it is superior to Google. Google has 184,000 employees. Perplexity has 55 employees, right? And what they have done is with 55 employees, they've built a better mousetrap. It is a better search engine. But, you know, like in my browser, like if I go in the search bar, like that's where Google is. Like if I want to go to Perplexity, I have to navigate to the website. Like Google is embedded in everything you do. So it's going to be interesting to see how, somebody like Perplexity or, any of these other competitors can dislodge, Google's dominance in search. And my position all along is that Google will lose market share in search over time. Because as a company, culturally, they got complacent. They hired a bunch of people that don't really do anything. The culture is a mess. And ultimately, it's really the same company that it was 10 years ago. They haven't innovated. I remember writing about Google in 2013, 2014, when they were in the process of building out Google Maps and Google Drive and all these other services. And they really haven't done anything in the last 10 years.
Because it's in their search engines already. Apple has it whenever you open your browser, it's Google. You think that there's a possibility that Perplexity could make a deal with some of these computer manufacturers, and you'd open your computer and it would be Perplexity or Perp or whatever they call their search engine.
Yeah, I think that is possible. I mean, that's kind of what I'm betting on. I have puts on Google, which are not doing so well at the moment. But they're 2-year puts, and I'm happy to keep rolling them. Um, so I mean, Google has developed their own AI search engine, as everybody knows, which is Gemini, and Gemini has all sorts of problems. So yeah, I mean, I think this will work long term.
And I think that Google, not only Gemini, I think they came up with a second version of Gemini trying to fix the problems that they had. So,
Yeah.
perhaps that, people listening could just go over to Perplexity and check it out and see if that's something that they would want to use. And I want to ask you about Apple for a moment, because this is another company that's losing market share. Obviously, in China, they're struggling quite a bit. And could AI boost them back up to where they need to be?
I don't know. I mean, Apple, I suppose it's possible. Apple is a hardware manufacturer, and it's a great company. They've been able to maintain these absurd margins for a long period of time. They still have these absurd margins. Um, I think Buffett was right to buy the stock 7 or 8 years ago, whenever he bought it. But yeah, I mean, I don't. Apple is a tough one. Apple is a tough one.
So, Jared, I want to talk for a few minutes about the debt and the amount of treasuries that we're pumping into the economy. And at some point, there's got to be a breaking point, right? The debt is scheduled to be about, I don't know, 116% of the economy by 2034. And is this sustainable?
Um, so just let me tell you a story. When I was first getting into the business in like 1999, um, I had a subscription to Barron's, and as you remember, Alan Abelson used to write Up and Down Wall Street as like the opening column in Barron's, and he would go on about the debt all the time. So, he would talk about not just government debt, but household debt and corporate debt. And he had this chart of total debt to GDP, and it was going from the lower left to the upper right. And he said, look, like we're at 200% total debt to GDP. This is unsustainable. Like the market's going to crash, right? That was Alan Abelson. He was like this perma bear. And here we are now. We're at 360% total debt to GDP, and nothing has crashed. And households and corporates have actually deleveraged a lot. Like what's actually where this is coming from is government debt. Um, so look, like when interest rates were spiking last year, and tens got up around 5%, you could see that there was a lot of pressure on the bond market because of issuance, right? We had these huge auctions and issuance was weighing on the market and it was causing interest rates to go higher. And I said at the time, I was like, look, like, people thought that we would get failed auctions and issuance can go higher. But I said, demand can rise to meet supply, right? And, for a lot of people, 5% on tens looks pretty attractive, especially after a period of time where we had, really low interest rates. Um, so I was of the opinion that demand would rise to meet supply, and we wouldn't have this problem of interest rates going to 7 or 8 or 9%. So I still believe that, and even if tens got to 5.5 or 6, it brings out a whole new class of buyers, right? So there's a lot of bond bears out there who think we're going to have 8, 9, 10% on tens. Like we might get there eventually, but it's going to take a very, very long time.
So, do you see this economy recovering at some point? I mean, not recovering. The economy, as far as the market and everything, is going very, very strong. But do you see it coming down to where the Fed wants it?
What do you mean?
Right now it's at 3.4%. CPI, they want it down to 2. Uh, it,
Oh,
it it's struggling. It's being very, very stubborn.
you're not going to get inflation down to 2% without a pretty severe recession. That's what it would take. Um, it would have to be a very severe recession to get inflation back down to their target. And it's funny because there was a lot of internal discussions at the Fed of whether they should raise the target from 2% to 3%. And they didn't, because that would have been an acknowledgement of defeat, basically, that they've given up on the 2% inflation target. But I think that sort of the whisper inflation target really is around 3%. Because if the inflation target was actually 2% and we're running 3.5% CPI, they would still be hiking rates here, but they're not, you know. So I think for the time being, they're satisfied with CPI in the three handle.
Yeah.
So
So if unemployment continues the way it's going and there's less money circulating because people are spending less money, that number will continue to come down and they'll get close to the 3% number that we're talking about. And that'll hopefully make them happy. The question is, once it gets to 3%, how long do they leave it there before they say, okay, you know what? Now we can go 25 bips or even 50 bips and figure, okay, you know what? We brought it down. Let's see how it reacts and go from there. Like you said in your newsletter, what would be worse is them to lower rates and then have to hike them, or to hike rates and then have to lower them.
yeah,
So it's they get stuck in that situation where, what do we do once we get what we need?
yep, yep. Um, well, I think it would be much worse for them to lower rates and then have to hike them for sure, reputationally. So I don't think we're going to get that. Even with today's data, I don't think we're going to get that rate cut before the election. Could be wrong, but that's what I think.
Where do you see the economy? Obviously, they don't want to. The Fed doesn't want to influence this election at all, and I know that that's in their back of their mind. But where do you see the economy going after November?
Well, it totally depends. I mean, obviously, it depends on who gets elected. I think if Trump gets elected, it's more interesting because you have a president who is allegedly drafting plans to weaken the independence of the central bank. And Trump explicitly wants interest rates lower. I think one of the first things he does is if he's president is if he fires Powell, and somebody like Kevin Hassett becomes Fed chair. At which point, Kevin Hassett would be a factotum and would probably lower interest rates, at which point the yield curve would steepen dramatically. You'd see twos go from 4 to 3, and tens go from 4.5 to 5.5 or 6. You would see like a 200 or 300 basis point steepening in the curve. Um, I think that would happen almost immediately. You would see a massive steepening after Trump got elected. With Biden, it's kind of more of the same. Um, high interest rates, growth outperforming value, all the stuff that we've had for the last 4 years. Like you just get more of the same. So
Where do you stand on Bitcoin
I don't stand anywhere on Bitcoin.
or cryptocurrency? You're not interested at all.
Well, I'm interested, but I'm not involved. I'm not involved at the moment. So, um, I mean, look, like the ETF demand got Bitcoin above 70,000. I think that's kind of tapered off at this point. I guess the only thing I would say about Bitcoin is I would much rather own gold, especially when it comes to geopolitical tensions, because as we saw during this whole Israel episode, gold responded positively to geopolitical tensions while Bitcoin responded negatively. And Bitcoin is not, if it is a store of value, it's not behaving like a store of value. It's behaving like a tech stock. So if you're looking for a store of value, a hard asset to put in your portfolio, what you're going to do is you're going to make it more positively correlated with everything else in your portfolio, and you're going to make it more volatile. Gold will reduce the volatility of your portfolio.
Yeah, and the volatility index kind of says that we're going to continue to have volatility in the short term. So, Jared, how are we making money today? How is it, what are you advising people to do with their money if they have it on the side, and or even fixed income? How are people making money today?
I think that probably most people do not have a large enough allocation to commodities. Okay. For example, if Trump gets elected and the Fed starts cutting rates, that is going to spark off a big boom in commodities. The dollar is going to get much weaker, commodities will go up. And I think people's allocation to commodities is probably very low. It's probably in the single digits, the low single digits. So I think people are massively underexposed there.
And that's part of your 20% rule,
Yep.
is partly in commodities and oil. Now I was kind of surprised that oil dipped down below $80 a barrel, only because of the tensions in the Middle East and what's going on there, and with Iran and all of that. Where does oil sit from here?
I don't really have a strong view on oil. I was kind of wondering the other day if the price of oil is kind of front running another drawdown in the strategic reserve. I think that's possible. Like, there's not much left in the SPR, but we could get another drawdown of the SPR before the election. So I was kind of wondering if oil was kind of front running that. But other than that, I have no ideas.
Jared, thanks so much for joining me, and I appreciate your work, and I enjoy the interviews that I get to watch. I watched your interview with Ed Malden and about your book, and it. I was enlightened by the fact that you say to people, you know what, go out and buy your $7 Starbucks coffee, but you don't need to drive the Rolls Royce, and
Yeah.
it's part of being not stupid with your money, right? Indulge yourself every once in a while, but do it in a smart way.
Yeah, I mean, I got a cabinet over here full of like Nespresso pods that are like $1 a piece, but I drive a Toyota Highlander with 120,000 miles on it. So,
So there you go. So even the people in the business that trade and all that stuff, they even very smart with their money by not being stupid.
yep.
So, Jared, thanks so much for your time. I really appreciate it. The Daily Dirt Nap. Where can we? I know we can read that. Where can we find you on social media, and where can we find the Daily Dirt Nap?
Twitter, you can find me at Daily Dirt Nap. That's my handle. And if you want to subscribe to the newsletter, it's dailydirtnap.com.
Great. Thanks so much for joining me. I really appreciate it.
Thank you.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com and sign up for a free, no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we would greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish.